So within chapter 5, let me just kind of just go back to the module itself. So chapter 5, again, you're going to have the same type of assignments. You got chapter 5 assignments, chapter 5 assessment, and then there are extra credit opportunities as well, which I encourage you to try. It's going to show in there right now that they're worth, that it's 5 points out of 5 points. I will change that. I think I mentioned at the beginning of the semester that the extra credit points are kind of, you have to do some manipulation in Canvas to get those to come out right, which I do at the end of the semester. So today, we're going to talk about these, well, it's actually 2 different unemployment taxes. There's something called FUTA, there's something called SUTA. Those are acronyms, obviously. FUTA is federal unemployment tax, SUTA is state unemployment tax. Both of these taxes are taxes that are paid by the employer. FUTA is exclusively paid by the employer. SUTA is for the most part exclusively paid by the employer, but there are some states, because it's a state unemployment tax, the rules for it are going to vary from state to state. Some states do impose a partial unemployment tax on employees, so there is a withholding element. In Iowa, that is not the case. So in Iowa, employees, there's no employee portion of these taxes. These are solely taxes that are paid by the employer. So there would be no withholding in Iowa. So we're going to go through both of these taxes, what they are. They work together in conjunction with each other. And we'll talk about kind of how they work together, and as well as what the responsibilities are for each of these types of taxes. And we'll go into a little bit more detail as well. We'll end up today talking about the actual tax rate. Once we've discussed what FUTA tax is and what SUTA tax is, we'll start talking in specifics about FUTA tax itself. We're going to start there. We'll go into more detail on SUTA tax on Wednesday. But we'll talk about the tax rate and what the tax base is for FUTA tax. So what types of income are taxed or subject to FUTA tax, and then what is that tax rate that is applied. We'll also discuss, I'm not sure if it's today, but remember we have that, there are 2 parts to all of these taxes. There is the actual collection of the tax and depositing it, and then there's also the reporting of the tax. So with federal income taxes, Social Security, Medicare tax, we had that Form 941, right? Where we reported all of those taxes, all of the income that related to those taxes and the taxes themselves. And then that was filed on a quarterly basis with the IRS. Everybody remembers that, hopefully. I have no idea because none of you are looking at me or paying any attention. So maybe you're paying attention, you're taking notes on your laptops. That's fine. But just recall that we used that Form 941 when we were reporting those taxes. Now with the unemployment taxes, we have a different form that we have to become familiar with. And it's called a Form 940. Luckily, it's only filed once a year. And the rules for depositing those FUTA taxes are a little bit different. They're less complicated than the rules for depositing the income tax, federal income tax, and Social Security and Medicare tax. So we'll go through what those rules are as well. So let's get started, and we are going to go back to using the PowerPoints here. And I think I want to download this. It's easier to manipulate. Come on. All right, so here are basic objectives for this chapter. We will get into some calculations, but of course we've got to kind of get a little background. Oh, one thing I wanted to point out, sorry, before we get started here. In the module, I never know how to just go back, I guess this way. So in the module, there are a couple of links that I have put in that give you a little bit of background on the history of unemployment tax and some basic facts about the unemployment tax. So I don't expect you to read through this in detail. This is quite lengthy and pretty small print and not a whole lot of pretty pictures to look at, some graphs in there. But if you're interested in some of the history and more details about how it works, if you want, this presents the information, kind of the same information that the chapter presents, but in a different format. So there's a supplemental article there for you to take a peek at. And then this, hopefully, just gives you some history of the Federal Unemployment Tax Act, which created federal unemployment tax. You can see, just like that Social Security Act, remember we talked about that was created in the 30s, Federal Unemployment Tax Act was also passed in the 30s, 1939 in particular, again in response to the Great Depression. So a lot of these taxes and these social programs we see are related to that period of time. But you can also get a little bit of history there of the system. This one's not as lengthy as the other, but feel free to peruse that. I'm not going to go through that in detail with you. I just wanted to make you aware that it is there for you. I don't have any video this week, sorry. Usually I start out with a video, but I think I looked for some videos, but they were also uninteresting. But meh, that's all right. Okay. So let me get back to the PowerPoints. Okay, so what we're going to do here, we're going to describe the requirements for classification as an employer or an employee under Federal Unemployment Tax Acts. Spoiler alert, pretty much the same as the definition for employer-employee relationship for Social Security Medicare tax and for federal income tax withholding. So not a whole lot of new information there. Again, there has to be, federal unemployment tax only applies to individuals who are classified as employees, not those independent contractors. There has to be that employer-employee relationship. We're going to talk about what is defined as taxable wages. Again, pretty much the same as how we define taxable wages for Social Security Medicare and for federal income taxes. But we'll go through that. Then we're going to talk about how we do that computation. This is the area, I'll just give you a hint. This is the area, I don't want to plant the seed in your head that somehow this is difficult. However, what I will tell you is this credit against the tax is probably the area in this chapter that students struggle the most with. There is a credit, there's a tax rate, but then also employers get a credit against that tax rate. Essentially what it does is lowers the tax rate as long as they meet certain conditions. So it lowers that tax rate. So we'll talk about that credit against the tax. It's confusing because usually we think of credits lowering a tax directly, but what we're talking about here is a credit that lowers the tax rate. So the tax rate comes down. Also, any other types of reductions that apply to that rate. Whoops. We are going to talk about how, okay, so then we're going to move to talk, and all that stuff before was mostly about FUTA. Then we're going to focus more on SUTA, state unemployment tax. Let me write those down for you just so you're, so FUTA, it's an acronym for Federal Unemployment Tax Act. So that's where our FUTA comes from. And then SUTA Same thing, except it's state unemployment tax act. And these are both federal laws that were passed. And even though this says, state unemployment tax act, what this did essentially was it told the states, you have to do this, and this is how you're going to do it. Okay, so it is a federal law, but the SUTA part is run by the states. So we're going to talk about this experience rating system, which is used when calculating SUTA, and it's used to determine what essentially the tax rate is for employers. You're going to find this is kind of funny. So FUTA has standard tax rates, has a standard tax rate, and then there might be a credit against that tax rate that helps to reduce the tax rate. In fact, in most cases, employers will get that full credit that they could be entitled to. When we talk about SUTA tax, though, it varies. The rate varies by state, and it varies by employer. So one employer may have a specific tax rate, and another employer right next door, same state, has a different tax rate. So this experience rating system is used to help to determine what that rate is going to be per employer. So that's another kind of more complicated area of this chapter that we'll spend some time going through some problems on that. Reports required for Federal Unemployment Tax Act, that's the one I was just talking about. It's called the Form 940 as opposed to the 941. Now for FUTA, it's the 940. And we'll take a quick look, and we'll use Iowa as an example. Each state has their own reports as well that have to be filed. Even though the 940 is filed annually, the state reports are generally filed on a quarterly basis. One of the things that you'll find here that's kind of interesting is you'll see the difference. The FUTA taxes that employers pay are generally a lot lower than the SUTA taxes that they pay. And we'll get into why that is here when we start looking at these two. So, Federal Unemployment Tax Act was passed to fund unemployment compensation as ordered by the Social Security Tax Act of 1935. So, part of the Social Security Tax Act of 1935 said we're going to start this FUTA program. It didn't actually start until 1939, but the 1935 is related to the Social Security Act. It's a federal law, again, imposes a tax on employers, and that tax is based on the wages that were paid for covered employment. Covered employment simply means those that where that employer-employee relationship exists, and amounts paid for wages. Okay. State Unemployment Tax Act. So this again was passed by the federal government, but it is imposed at the state level. Each state has what they call a trust fund. It's financed by state unemployment taxes. So that means the states collect the tax from employers, and then they pay out benefits, unemployment benefits, from the amounts that they collect from the employers. Okay, so all of the funds, like if you've ever received unemployment benefits, and I know a lot of people did, especially during COVID, all of those funds are from the state, and the funds are coming directly from the amounts of tax that employers pay into state unemployment. Okay, every state, as well as the territories of the U.S., have their unemployment compensation laws. They can make their own laws, but it has to be approved by the federal government. So they can pass their own laws. This is why they can have their own rates, their own tax rates. They can have their own rules regarding what the benefit period is, like how many weeks somebody can receive employment benefits, after what period of time, how long do you have to be unemployed before you can start receiving those benefits. They can make their own rules. Each state has the ability to make their own rules on those things. However, it has to be approved by the federal government. Okay. I do want to say, let's see, before we get into that, one of the things I wanted to point out that's not really clear on this slide. So I had mentioned that these two taxes work in conjunction with each other. They're two taxes, two separate taxes, so employers have to pay both of them. The federal unemployment tax essentially just funds administration of the program. So it pays for the salaries of the federal employees who regulate all of the states and ensure that all of the rules in the states are being followed. So that tax is being collected to essentially pay salaries of individuals. So it administers all of the rules. The SUTA tax, however, as I had mentioned, that tax is collected to directly fund unemployment benefits. So when somebody becomes unemployed, if they are eligible, and we're not really going to go into the benefits and eligibility and how you're eligible and all of that stuff. I don't have information on the benefits. I have information on the tax part of it. But SUTA, all of those funds are going to pay those benefits. So when somebody receives those unemployment benefits. So I had said earlier that FUTA tax is lower, generally speaking. It's a smaller tax that employers pay than SUTA tax is. It makes sense because all FUTA tax is doing is going to pay those federal salaries of people who administer the program. It's not going to any benefits. No benefits are being paid out of those FUTA taxes. But at SUTA taxes, that's where those benefits are being paid. So obviously, the SUTA taxes, that tax has to be higher because the expenses that it's paying are a lot higher, right? All right, so when do employers have to pay FUTA tax? And again, we're going to start with FUTA tax. They're liable if either of the two tests apply. First test is they pay wages of $1,500 or more during any calendar quarter in the current or preceding calendar year. So they'd look at 2025 and 2024. And did they pay wages of at least $1,500 in any quarter during that time? That's a pretty low level of wages. If most employers who have employees probably would pay at least that amount. So if they paid $1,500 or more, or if they employ one or more people on at least some portion of one day in each of 20 or more calendar weeks during the current or preceding taxable year. So this one is a dollar amount requirement, that $1,500. This one has to do with whether or not they had at least one person working. Some portion of a day, could be just an hour, in at least 20 or more calendar weeks during the current or preceding year. Most employers, again, most employers, those companies that employ individuals, are going to meet one or two of these requirements, right? It's very easy to meet these requirements. So that means they're subject to FUTA tax, and they have to pay the tax, calculate it, and report it every year. So here are just some definitions. A calendar week is seven successive days beginning with Sunday, so it's always going to be Sunday through Saturday that they're looking at. The 20 weeks do not need to be consecutive. So you could employ somebody for 1 hour on week 1, 1 hour week 4, 1 hour week 5, 6, 7, week 14. They don't have to be consecutive. If it was 20 weeks, that counts. And they don't have to be the same employees. So it could be different individuals. And that just means that the employer then is subject to paying that FUTA tax. So regular, part-time, and temporary workers are all considered to be employees. Doesn't matter if you're part-time, doesn't matter if you're temporary. Also, determining the employer status, employees do include individuals that are on vacation or sick leave. They're still considered to be employees. Members of a partnership. So when they say members here, what they're talking about are the owners, the partners. Partners in a partnership are not considered to be employees. Just like they're not considered to be employees for Social Security and Medicare tax purposes, and they're not considered to be employees for federal income tax withholding purposes. Same thing for FUTA. And again, there's some special rules for agricultural and household employees, just like what we talked about with the other taxes as well. So the definition of who is an employee for FUTA tax purposes is generally the same as the definition of who is an employee for the other taxes that we've discussed. Okay. Are there any questions so far? I know it's an exciting topic, FUTA tax. Okay. So an employee is generally considered, an individual is generally considered an employee if that common law relationship exists. We talked about that way back in what, chapter 2? That common law relationship. So all has to do with the facts and circumstances of who has control over the how the work is done, when the work is done, how an individual is paid. Remember, we had that financial and behavioral control, so the same sort of definition. If the employer has the right to direct and control employees' activities, there are a couple of classifications that are specifically included regardless of that control issue. Those are agent drivers or commission drivers who distribute food or beverage or deliver laundry, very specific careers here. Also, traveling or city salespeople in certain situations. They are specifically considered to be employees for FUTA tax purposes. There are some specific exceptions. Casual laborers, oftentimes considered to be day laborers. So people who just work, there's a job to be done and they're hired that day to do the work, and then there's no commitment to have them do work any other time. So they are excluded from FUTA. Partners, as we already talked about, partners in a partnership, and directors. Now pay attention to this because I know you have a homework problem that involves, you have to determine who is covered by FUTA tax. And I know that there's a specific homework problem that involves partners and directors. So directors, like in the board of directors, members of the board, oftentimes they're paid, but they're not considered employees of they're given more of a stipend, but they're not really considered employees of the company. They just help to direct policy of a company. Also, foreign students and exchange visitors are specifically excluded from FUTA tax as well. All right, so who's covered under SUTA? Generally speaking, if you are covered under FUTA, if you met one of those definitions, you're also covered under SUTA, which means when I say covered, again, that means that the employer has to include your wages in the calculation of the tax that they owe, the amounts that they owe. And also it means that you would be eligible for benefits should you become unemployed and would qualify. So obviously employees. Employees are generally considered covered under SUTA if they're covered under FUTA. There are there's some minor variations that might exist in certain state laws. For our purposes, if they're covered under FUTA, they're covered under SUTA. There is this ABC test that is used to determine whether they should be excluded from SUTA coverage. If they meet all three of these tests, then they would not be considered covered workers. So their wages would not be subject to this test. But all three of them have to be met. So one is that the work has to be free from control or direction. So the worker is doing it in there, however they want to do it, whenever they want to do it. There's no control. So we kind of think of independent contractors when we think of that usually. The jobs are performed outside the usual course of business, so it's not part of the usual, like if you're try and think of an example here. Let's say you work for a retail outlet. You help sell clothing. Let's say you work at a store at the mall and you help sell clothing at the mall. The way that the company makes money is by selling clothing. Retail. That's their usual course of business. But if your employer says to you, hey, we want to hire you to clean after hours to clean the facility, because we know you're really good at that. We want to hire you after hours to do that. Well, that work is not part of the usual course of business, right? So it might fall under this. So that work itself of the cleaning of the facility may meet this ABC test. And then anything that they pay you for that work would not be subject to SUTA taxes for the employer. And you have to be customarily engaged in an independent trade or business. So again, this example, you work at the mall in the retail trade, but as an employee, you have a side hustle that you have a cleaning business, your own cleaning business. And your employer has asked you after your shift ends if you could do that, and they'll pay you for it. Then that work of cleaning would fall outside of the normal course of business, and they're telling you you can do it however you want. You use your judgment, determine when it needs to be done. We're not going to tell you it has to be done in a certain manner. We're not going to tell you when it has to be done. We're not going to tell you how it has to be done. And you have that separate business. In that case, that work outside of the retail business would meet that ABC test. So it would not be, the employer then would be subject to SUTA tax on the wages they pay you in your day job when you're working for the retailer. You're selling clothing, you're there, at your regular job, but they wouldn't have to include the wages or the amounts that they pay you for the cleaning part of it, right? So there's kind of two separate types of work that are going on there. So in that case, and that's the best example I can think of off the top of my head. There may be better examples out there, but so questions so far. Do we understand the difference between FUTA and SUTA? Can somebody explain to me the difference? Carla? Yeah, like the administrative costs. Yep.
And then SUTA is higher because that's where it came out from.
Right. Yep. Exactly. Excellent. Okay, so I'm glad we got that down, the difference between those two. And the fact that, pretty much the same, if you're an employee for Social Security, Medicare tax purposes, if you're considered an employee for federal income tax purposes, you are very likely, most likely, almost definitely also an employee for FUTA tax purposes and SUTA tax purposes, which means your employer is going to have to pay those taxes, and it's based on your wages. So just like the other taxes are based on wages that are paid, FUTA and SUTA are also based on wages paid. Okay. All right, so what happens when we have an employee? So it's state by state, right? And I said each state is going to have kind of their own rules. It just has to be approved by the Social Security Administration that helps to administer FUTA. It just has to be approved by them. But the rates in different states are going to be different, and even at each different employer. So if you are an interstate employer, so let's just say, Walmart. Walmart's got employees in every single state. They have 50 different rules that apply, 50 different SUTA rules and taxes that apply, plus the territories. I'm sure they've got locations in the Virgin Islands and in Guam and Puerto Rico, I'm sure they have locations there. So each of those places, yeah.
They have some in Mexico. What happened?
So Mexico's whole different because it's a different country. They're going to have their own rules. I don't know if they have a FUTA system or a SUTA system, but Walmart is going to have to follow the rules of those countries as well. But let's just look at the United States right now. A place like Walmart, they've got, like I said, they've got employees in every single state. And so they've got all these different state rules that they have to keep up with. Imagine being a payroll professional at like Walmart corporate headquarters. Now, I'm sure each Walmart has their own payroll where they specialize in paying those specific employees. But I'm sure that there are also payroll professionals that work nationwide to monitor and make sure that everything's being done properly. You've got to know a lot about the different taxes, the different income tax rates in each state, as well as the different unemployment tax rates and all those different rules. So you've got employers that have employees in different states, but you also have employers that have employees that work in different states. So maybe they work part-time in Iowa and they work part-time in Illinois, but it's for the same employer. So you could be, let's think about maybe a Walmart, I don't know what a position would be, where they work at different, if they're not just located at one particular, like a regional manager, that sort of thing. And they're working some of the time in Iowa. Their region is Iowa and Illinois and Wisconsin. And so they're overseeing all of these different companies. Well, what state do they work in? That's important to know because in whatever state they're localized in, that's the rules that they are subject to, right? So we have kind of these steps that we take to determine where they're going to be taxed. Are they going to be taxed? Are their wages going to be taxed in Wisconsin? Are they going to be taxed in Illinois? Or are they going to be taxed in Iowa? Because again, we've got different rules in each of those states. So where are they going to be taxed? So they've got these rules to prevent the duplicate contributions on the services of interstate employees. So Walmart's not going to pay SUTA taxes in all 3 states for all of that income. That would be triple taxation to them on the same wages, right? So if the regional manager is making $100,000 a year, but their work is divided, $30,000 of work in Wisconsin, $30,000 of work in Illinois, $40,000 of work in Iowa, they're not going to be taxed $100,000 in Iowa and $100,000 in Wisconsin and $100,000 in Illinois. That would be wrong, right? They're paying too much tax. So we have to determine in a particular order where they're going to be taxed. The first one is we want to look at where the work is localized. So where is it? And in this case, in our example, it's not really localized anywhere. We've got it divided 3 ways, 3 different states. So if we can't determine where the work is localized, then the second step is we look at the base of operation. So where are they working out of? Maybe their office, that regional manager, their office is in Illinois. And that's where they do a lot of their administrative stuff. But we know they're working in these other states, but most of their work, that's their base of operations. If that's the case, then we could just stop at number 2 and say, okay, it's Illinois. Illinois is the answer. That's where they're going to be taxed, is Illinois. But if we can't determine based on that, we would look at the location of the place from which the operations are directed or controlled. Well, in that case, if this regional manager has no base of operations, what we look at is, well, where's their boss? If they work for Walmart, probably in Arkansas. That's the corporate headquarters of Walmart. So we'd look there. Okay, well, then it's Arkansas, even though they don't even work there. That's where those are the taxes that would be applied. If we still don't have a clue based on this, so there's no specific place from which the operations are directed or controlled, just based on the facts and circumstances, then we look at the location of the employee's residence. That's last. Let's say this person lives in Iowa. It's possible. Live in Davenport, but office in Rock Island or something like that across the river. We'll look at the location of the employees. I guess Dubuque would probably be a better example because that's close to Wisconsin. Where do they live? That's where the tax is going to be assessed there. Okay, so we've got this, and this is all in order, and you kind of just go through and look at where they are. Now we also, I think, and we have, let me kind of go forward here because there's at least there.
They claim benefits and they're doing remote work, living here. My company's based in Georgia. You want to collect unemployment.
So it would be determined by that. So their location, if it was determined that Georgia was their base of locations, they're going to collect, that's where they would go to collect those unemployment benefits, even though they're here in Iowa. It would be because that's where it was taxed. So it's kind of, it can get kind of confusing, especially now when we do have so much remote work, right? So let's look at an example. I'm going to go back to those other slides as well, but this example goes along with what we just looked at. So we've got George. George is a resident of Arizona. He works as a marketing executive in a cell phone manufacturing company. His job requires him to travel and perform services in Illinois, Michigan, Arizona, and Ohio. His work is equally divided among the 4 states. So if we go back to look at where was it here? So there's really no place where the work is localized. It's all equally divided amongst those 4 states. He receives instructions from all 4 locations. Lucky guy, he's got 4 bosses. That's just so wonderful. Hopefully they all tell him the same thing and not different stuff. And the business records are maintained in Ohio and Michigan. Okay, so let's go look back at this too. So he receives instructions from all 4 locations. So this one, location of the place from which the operations are directed or controlled, really wouldn't apply because it's all 4 equally. And the operations of the company are controlled from the offices located at Illinois, Michigan, and Ohio. Okay, so we can take, so the base of the operations would be, where is it? Oh, I'm sorry, I skipped something. So the receives instruction from all 4 locations. Business records are maintained in Ohio and Michigan. So that would be kind of the base of operations. So it's going to be either Ohio or Michigan because we've narrowed it down to those 2, and that was part of the, where'd we go here? The second factor, base of operations, where are all those records located? Operations of the company are controlled from the offices located at Illinois, Michigan, and Ohio. Okay, so we've still got Michigan and Ohio. George is covered under the following states as per George is covered under which of the following states as per the rules laid out for interstate employees under SUDA. So, job requires him to travel, all 4 of those, equally divided. Business records are maintained in Ohio and Michigan. He lives in Arizona. So we really can't, so the place where the work is localized, we don't really have one. It's all equal. Location of the base of the operations, we don't really have one. It's either Ohio or Michigan. Location of the place, the records are located there. Location of the place from which operations are directed or controlled, again, we don't really have one. He's got 4 different bosses all in different places. The last thing we've got is the location of the employee's residence. He is a resident of Arizona. So that's what we are left with is, whoops, where we go here. He's in Arizona. So that's where they're going to pay their unemployment taxes and be subject to those SUDA laws. With regard to George, George might be one of 1,500 employees. So you got to determine this for each of those employees if you've got a multi-state company and you've got employees who are working in different locations, right? So, I guess I did. Well, I didn't see the answer. All right, so that's where the employee works for one company, but they work in multiple areas, trying to determine that. Now, we also have these interstate reciprocal coverage arrangements. If, by applying the order of the previous slide, coverage of interstate employees cannot be determined, maybe he's got an apartment in all 4 of those places, right? Yeah. Yeah, one would hope that he is. He certainly should be getting his travel reimbursed, if nothing else. States can enter into arrangements under which the employer can elect the coverage of the employee in one state. So if even after going through all that, there's just no one state where it applies. Or maybe he even has an apartment in 2 states, Arizona and Ohio. Something like that. In which case we wouldn't be able to determine it. So the employer can choose the state that, now in order to do this, first they have to fail all those other tests. They can't determine it based on those 4 factors. The employer can choose the state in which all services of interstate workers are to be covered based on the most advantageous wage base and contribution rate. They can look at the tax rates and say, well, you know what? Arizona has the lowest tax rates, lowest SUTA tax rates. So guess what, George? You are going to fall under the laws of Arizona because that's what we're choosing. Once the employer chooses, the employee also has to consent because the employee is now going to be subject to the benefit restrictions in that state also. So they have to be comfortable with that. Now, of course, with an employee-employer relationship, oftentimes employees will feel compelled to just agree with their employer because if the alternative is, oh, well, George, we'll find somebody else who will agree to that, then you'd be like, okay, fine. The employee consents, the state approves the election of coverage. If the employee is transferred to another state during the same calendar year, the wages covered, so this is a whole separate area here. The wages covered by unemployment compensation law of the previous state are included by the employer in order to determine the taxable wage base. Okay, we haven't talked about this wage base issue yet with regard to unemployment taxes. But just like with Social Security taxes, remember we had a wage base. It was only taxed up to a certain point. For Social Security tax, that was the $168,200. Do I have that right? It changes every year, so I forget. We have the same thing with FUTA tax and SUTA tax. It's only the first certain amount of wages that are subject to taxation. So, and again, for SUTA tax purposes, that varies state to state. So in Iowa, and I can't remember the exact number in Iowa, you have a chart in your book, and we'll look at it as we go through this chapter. Iowa, it's something like the first $34,000 of income is subject to tax. So if you make more than that, none of the amount over that during that calendar year is subject to SUTA tax. But it differs from state to state. Illinois, the maximum might be $14,000. So it's only the first $14,000 of wages that are subject to that SUTA tax amount. So if we've got an employee that is transferred, so they work for the same company. So here, let's go back to Walmart. Let's say we've got we got a manager at Walmart who's been working in Illinois, and they transfer him or her to a location in Iowa. Same employer. In that case, and like I said, we've got a different wage base and we've got a different tax rate. Well, what they do is they'll include the taxes that were paid in the previous state in the calculation of what's remaining for the new state. So whatever was paid for Illinois state unemployment tax, they'll give a credit to the company and apply that toward the Iowa for that first taxable year, that first calendar year. during that transfer. So that really only applies to employees who are transferred with the same company to a different state. Okay. All right. Now we also have U.S. citizens who work abroad. Whether or not they are subject to, their wages are subject to FUTA tax or SUTA tax depends on whether the company is an American company or a foreign company. So if they are working for an American employer, they're still covered. And they're going to be covered under the rules of the state in which the company is incorporated. Yes. Yeah. Well, I'm sorry. First, it would be the employer's principal. Well, I'm sorry. The employer's principal place of business would provide the coverage. So, like for those multinational, multi-state companies, it would fall to that, where their charter is. But if there isn't, like let's say it's it's a company that only works in one state, they're not all over the place, then it's going to be where where they're localized. So like Principal Financial, they're not in every state, but I think they've got some overseas locations as well. They'd be covered under if they're an American citizen working for Principal in, say, London, they would be covered under the state, the Iowa rules, under the Iowa SUTA. If the principal place of business cannot be determined, then it's the state of incorporation or if it's a single owner, wherever the owner lives. Now, again, this is only for Americans that are working for American companies. If they're working for a foreign company, Americans working for a foreign company, there's no requirement for them to be covered, right? It's going to be whatever the rules are for that foreign company. So there are a lot of pharmaceutical companies that are foreign companies. I think like AstraZeneca, that's a British company. If you're an American working in England for AstraZeneca, you're not going to be covered under this because AstraZeneca is not an American company. If you're an American, though, working for AstraZeneca in the United States, then you're going to have to be covered. AstraZeneca is going to have to be familiar with the U.S. rules, and you're going to be covered under whichever state in which you're located. So, yeah.
So, I know that if you're paying money, but if you don't live like in the country, you still have to put your money taxes.
Yes.
But like, if you're working in another country, you're paying their taxes.
So there's a foreign tax credit that takes care of that. So you're not taxed twice on the same income. Yeah, but yes, you have to, for income tax purposes, you have to report your income that is earned worldwide if you're an American. So again, these are for Americans working overseas. If they're working for an American company, that American company is still going to have to cover them under FUTA and SUTA. SUTA is going to be determined first if there is a principal place of business for that company. If that can't be determined, then it's the state of incorporation, or if it's a single owner, wherever that owner lives. So qualifying for benefits. I don't know why they put this in here. Claimants must have earned a minimum base period wage. So this is going to vary per state what that is. And I'm not quite sure why they put this in here because I don't like to get into benefits. It varies so much state by state. There are lots of requirements. So and if we look, in fact, let's pull up your textbook so we can look at some of the states. That might be the best thing to do. Okay, So, came right up to it. There is a table. If you have a paper copy of the textbook, it's easier to see this, but if not, this is the best we can do. So let's take a look at Iowa. What this table does, well, actually, let's look at the top here first. So all the states are listed over here at the left. This is so hard to read because they've got it crunched up. So here we've got the employer minimum and maximum rates. So let's take a look at Iowa. What this means is, and here's I don't know why this is size of the firm. This is, I think you have to have worked for the company for this period of time at a minimum in order to receive benefits. I don't know what this size of firm, one employee, because that doesn't make any sense, size of firm. And then it's talking about weeks. Anyway, let's look at Iowa here. So the lowest tax rate in Iowa is 0%. That's a pretty good tax rate. Only better tax rate is a negative tax rate. Don't get that. You don't see that very often. Lowest is 0, highest is 7. So for SUTA tax purposes, depending upon the employer, they may have a 0 tax rate on wages. They may have a 7% tax rate on wages. And that is on the first $36,100 of wages for each individual employee. So if an employee makes $37,000 a year, just think of how Social Security taxes work. Remember, it was just up to that amount, it was subject to tax. After that, there was no tax applied. But they're still subject to tax on that first amount. So for Iowa, the first $36,100 of wages for each individual employee is subject to SUTA tax. The rate on that could be anywhere from 0 to 7%. Now, how that 0 to 7% is determined, and this is kind of giving you a little preview of that experience rating, is the higher. So for employers, the more individuals they have that seek unemployment insurance, that apply for unemployment benefits, the higher their tax rate is going to be. It's just like any other kind of type of insurance. If you use your insurance more, if you have a lot more claims, your insurance rates are going to go up. You have car insurance. If you get into an accident and request reimbursement, your insurance rates are going to go up. This is the same sort of thing. So the employers, the higher the usage of the unemployment benefits. So if they have a tendency to have a lot of turnover, they fire a lot of employees, but not for cause. They have a lot of layoffs, that sort of thing. That is going to increase their usage. That means their rate is going to go up in the future. If, however, their usage is lower, they don't have anybody that applies for unemployment benefits, their rate is going to go down. Now, there are certain industries where they just automatically have higher rates. Construction industry is notorious for that because construction industry, there are a lot of layoffs. There are seasonal layoffs. When individuals in construction are laid off, they get to apply for unemployment benefits. So that usage is very high, but it's just natural to that industry. There are certain other industries where they naturally don't have a lot of turnover. CPA firms, they usually don't have a whole lot of turnover. People stay there for a long time. They don't use it as much, so those rates for the employer are going to be lower. Let's see here. There is no waiting period, and this is for benefits. So there's no waiting period in Iowa for benefits. That means that you can get, if you're unemployed and you qualify for benefits, you can start getting them from day one. The amount of weekly benefits ranges from a low of $82. And I have no idea how they determine what your benefit is. A low of $82 to a high of $551. So you won't make, and this is for 2024, by the way. So I don't know what it is for currently for 2025. So that's the range, and it's going to be based on how much you earned with. No, it's taxable. Yep. It is subject to income tax because it's replacing income, what would have been taxable. And the longest amount, the longest duration for each incidence is 26 weeks. So you can only receive these benefits up to half a year. And then you don't receive the benefits anymore. Now you can see on these charts, each state is different. So we've got Kansas here, whose lowest tax rate is 0.17%, highest tax rate is 6.4%, but they only tax the first $14,000 of wages. Iowa taxes up to $36,100 of wages. So Iowa's going to be collecting more in taxes, right? Kansas is going to be collecting less because their highest rate is lower and their wage base is lower. So their benefits, I would imagine, well, not necessarily. I thought they might be less generous, but they're not. Well, they are less generous. You can only collect benefits for 16 weeks in Kansas. Iowa, you get an extra 10 weeks. Lowest amount of weekly benefits is 135. Highest is 540. That's in Kansas. Now, if you look, there's some places. Let's look at this one. Highest benefits are 855. What is this? Massachusetts, otherwise known as Taxachusetts. Massachusetts, their lowest rate is 0.56%. Highest rate is 8.62%. It's on the first $15,000 of income. So if you make more than that, any wages above $15,000 are not going to be subject to tax. You do have to wait a week, so you don't get it immediately. But your highest benefit is $855 a week. Lowest benefit is $103, and you can get benefits for 30 weeks in Massachusetts. So you can see this is a good example of how you can see that each state has different rules. And if you've got employees in different states who fall under those different rules, you have to be familiar with what the requirements are, what the tax rates are, and everything in each individual state. We already did that. We already did that. Okay. What time is it? 2 o'clock. All right, so we can start getting into this a little bit. This is where we'll start doing some calculations. Actually, I don't know if we'll do any today, but so first we're going to start with FUTA, where we talk about tax rates. So I just showed you the variation in tax rates and tax base for each of the states. For FUTA, it is standard across the board. So everybody in the U.S. or one of those territories is going to be subject to FUTA taxes. The wage base for FUTA is $7,000. So it's only going to be on the first $7,000 of income. That is per employee. No. Nope. So if you make $10,000, if an employee makes $10,000, there's $3,000 that's not going to be subject to FUTA tax. It's just the first $7,000 that are going to be subject to FUTA tax. And this is the amount that's paid during any calendar year. Now, keep in mind that when we're talking about this, we're talking about for each employee at each employer during the calendar year. So if you, as an employee, if you have multiple jobs, that $7,000 wage base applies at each job. That's different from Social Security. Remember, Social Security wage base applied per individual, regardless of how many jobs they had. For FUTA purposes, though, it is per employee per job. So if you have 10 jobs during the year, that $7,000 wage base applies at each job. Okay, so each employer has to meet that $7,000. So $7,000 only on the first $7,000 that is paid during every calendar year. Wages include bonuses, advances, and commissions. So just like Social Security and Medicare and all those other taxes we've talked about. Retroactive wage increases, what that is let's say September comes and your employer decide you should have gotten a raise in January. And so what they do is they go back and look at what you've worked, your hours worked from January to September or January to August, and they give you, let's say they were going to give you $1 an hour raise. They then go back and give you that $1 an hour on all of the hours that you've already worked. And it's going to be one lump sum payment. But that's included. Those retroactive wage increases are included. Again, it's only for the calendar year, though. Okay? Although if they go back further than that and they pay it, depends on when they pay it. So if they pay it, you know, they go back a couple of years, but then they pay it in 2025, it applies to 2025. Tips are included. Transfer of stock. If the employer pays the employee in stock, which happens, employers will give employees, in addition usually to their regular wages, they'll give them they may give them stock or the option to purchase stock at a discount. If that happens, then the fair market value of the time of that payment is the taxable base, and it's included as well. Lots of other different types of wages, many of them we've already talked about, are included for purposes of that taxable wage base. Again, and this is what I was just talking about, if an employee has more than one employer in a year, that wage base applies separately to each employer. Okay, so if they work at McDonald's, they work at Walmart, they work at Subway, got 3 jobs. Each of those jobs has a $7,000 wage base. So Subway has up to the first $7,000 of wages paid at Subway is going to be subject to FUTA tax. For $7,000 at Walmart is going to be subject to FUTA tax. For $7,000 at what did I mention? McDonald's is going to be subject to FUTA tax. So each of those employers has to pay that, even though the employee themselves doesn't, they've exceeded $7,000 in total, but it applies at an employer level. Okay. Questions about that? No? Okay. Let's see. Okay, so some non-taxable wages. Advances or reimbursement of ordinary business expenses as long as it's part of an accountable plan. So here we're talking about, like, if you get reimbursed for mileage, that's not considered wages. That's just a reimbursement for expense. You don't get taxed on that. That's not subject to any of the taxes that we've talked about. Retirement pay, not subject to FUTA tax. Educational assistance payments to workers. So remember we talked about employers can pay up to $5,250 for tuition reimbursement to employees. That is not included in the $7,000. Meals and lodging furnished for the employer's benefit. There's that distinction, employer's benefit or employee's benefit. If for the employee's benefit, that would be considered wages and included. Strike benefits paid by unions to their members. So oftentimes what happens if somebody is a member of a union and the union votes to go on strike, the union will, part of the dues that are paid, help to pay the individuals who are on strike. So they're getting some sort of payment because their paycheck is ending, or at least temporarily. That is not included in FUTA. All right, so we know that it's only the first $7,000 of gross wages. Here we're going to pretend it's just one employer for right now. We'll do some examples where it's multiple employers, but for right now we'll start with the simple, where it's just one employer. The tax rate is 6%. 6% of the first $7,000. So 6% of $7,000 is $420. So here's our, don't like that one. Times 6. This would be $420. This is for each employee. If you've got 100 employees and they all make at least $7,000 during the year, you're looking at $42,000 of FUTA taxes for the whole year because it applies to each employee. Now, this rate here can be reduced, and usually is reduced. It's reduced by 5.4%, up to 5.4%, as long as the employer meets certain conditions. There are two conditions, really. One of them they have no control over. The other one they do have control over. So this is called the FUTA credit. So like I said, if you have a maximum, if you have a maximum credit, we'll get into when it's a reduced amount. You would reduce your percentage by 5.4, which brings us down to 0.6%. Which means instead of $420 per employee, the most you're going to pay is $42 per employee. That's a little more reasonable. That's pretty cheap, right? If you're entitled to that maximum credit. Now, if you're entitled to some credit, but not all of the credit, let's say you're entitled to 4.4 credit, that means your tax rate is now 1.6%. This gets a little bit confusing because usually when we talk about a reduction, when we're talking about taxes, we think that's a good thing, that it's going to bring our taxes down. But we're talking about a reduction of the reduction, a reduction of the credit. So if it's a reduced credit, it means the tax rate is going to go up. If it's the maximum reduction, the tax rate is going to be, the lowest tax rate is going to be 0.6%. Okay, so 0.6. So most employers just pay that 0.6. Most. Not all, but most. Like I said, there are two factors that have to be met in order for them to get that lowest tax rate. One of those factors, let's see if the next slide says it before I get ahead of myself here. All right. One of those factors is that the employer has to have made SUTA contributions on or before the due date for filing. They have to have contributed all of their SUTA taxes. Now, remember, I'm talking about FUTA taxes here. This is FUTA. But in order to get this 5.4, one of the factors that has to be met is they have to have paid all of their SUTA taxes on time. They have to meet the deadline for paying those SUTA taxes. Why on earth would the federal government care if employers have made their SUTA taxes on time or not? Well, one thing that happens when employers when there's not enough money to pay out benefits is the federal government has to then loan states the money. So in order to encourage all of the employers to pay their taxes on time, they will penalize them if they don't. Because otherwise it increases the chances that the federal government's going to have to come in and make up that shortfall. How are we doing on time here? Oh, we're almost done. I'll get through this slide, and we'll go through this more. We'll go through some calculations, by the way. So that's the one. So, and that's under the employer's control, whether they make that payment on time or not. If it's not made on time, it's limited to 90% of the tax. We'll go through some calculations on this. This is just kind of a precursor of it. So even if the employer pays into more than one state unemployment compensation fund, the credit against the federal tax is still limited to 5.4%. As we already saw this, some states have a higher wage base than the federal amount. And this factors into the calculation that we'll do. So I'm not going to go into that in detail. When we get to the calculation, you'll see how this part works. So that's the first factor. They have to make all their payments on time to SUTA. The second thing that they have to do, and this is the one that they have no control over, really, is that they have to be located in a state that has not borrowed from the federal government and is late on repaying. So if you have the bad luck of being located in California right now, you can imagine California. Of course, California is one of those states that has borrowed from the federal government for unemployment benefits and is late on repaying them. That means that every employer in that state has this credit reduced. They're going to have to pay more in FUTA taxes because they're trying to make that up. The federal government's trying to make that. You owe us money. You're not paying us, so we're going to get it from all your employers. Now, that's supposed to put pressure on the employers to then put pressure on the state government to make payments. I don't know whether it works or not, but so the credit, in this case, the credit is reduced 0.3% per year beginning in the second year after the advance. So again, the two factors. Employer has to have made their payments on time, their SUTA payments on time. They can control that. They also have to be in a state that is not in default of their unemployment loans from the federal government. All right, so we're going to end it there. We'll get into some calculations on Wednesday. We're also going to talk about SUTA in more detail and tax rates for SUTA, but then we'll also get into some of these calculations. Okay? Questions?